Welcome back to Selling Your Business with David King. I'm David King, author of Selling Your Business, Begin with the End in Mind. It's available on Amazon. Today, I am joined by Andrew Vandyke with Modern Woodmen. He is a financial advisor in Meridian, Idaho. Welcome, Andrew.
Thanks for having me, David. I appreciate the opportunity.
And being a financial advisor, he's got to give us a little bit of a legal caveat to
Yep.
preface his. Go ahead.
So anything I say today is not financial advice. Leave that to me when we speak one-to-one, and we will, at that point, dictate a lot of this stuff. Today is just going to be my general thoughts and opinions, but nothing I say is financial advice.
Perfect. Well, then let's go ahead and lead into this uh, education that's not financial advice. Tell us about yourself. How long have you been working in financial advisory services?
Yeah, so I've been doing this for about 3 years now, a little bit over now, and started when I moved up here to Idaho. I originally was from Northern California. I call myself a little bit of a refugee, and yeah, I've been doing it for about 3 years now.
Have you been with Modern Woodmen the whole time?
Yep, been with them from day one. I did a good amount of research before I picked a firm to make sure that they had the things that I wanted to be able to do and could do what I wanted to do long term through them. And talked to a few different firms, couple independents, but this was truly the way that I wanted to go.
Tell me about your client base. What type of people do you typically serve?
Yeah, so my predominant client right now is small business owners, ranging anywhere from the solo entrepreneur all the way up to about 50 employees. Usually my business owners have been in business for about 5 to 10 years. They're at the point where the business side of what they're doing, they have something that makes them a consistent income. And they're either at the phase where they're bringing on employees or they brought on employees and they need to start offering benefits. Or, maybe they're just long-term trying to think about, if they're smart, how they're going to exit plan out of the business. And so most of my clientele are business owners that have been in for about 5 or 10 years. And like I said, clients or employees of about, 1 to 50 employees.
I see. And with those business owners, do you help them both with, say, setting up deferred compensation plans for themselves and their employees and their own separate savings to plan for their retirement and their exit?
Yeah, I think there's kind of this like perception that as a business owner for a lot of people that their business is their retirement, and in a lot of cases that can be in a certain capacity very true, but a lot of times I think people put too much weight into the idea that their business is going to just take care of them their entire life. And so offering defined benefit or defined contribution plans to not only yourself but your employees is one, a way for you to have guaranteed assets when you retire, to make sure that even if your business doesn't go the way you want it to, or even if your business goes exactly the way you want it to, you're going to have a passive income there to rely on outside of that business sale. And then your employees are going to be happy, because a happy employee is a productive company. And that's never been more true with all of the turnover that we're seeing in society right now.
And when you're working with them and helping them set up retirement plans, this is more of a legal issue than a financial issue, but the two are definitely intertwined here. Do you impress upon them the fact that the money that they set aside in their retirement plan is a safe asset, meaning it's safe from creditors? If something terrible happens and you get sued above the limits of your insurance policy, the money that's in your retirement is staying there.
Yep. And that's also the case too with cash value life insurance policies. And so that's something to also take into account. But yes, that is absolutely a conversation that we have. And is something super important to be thinking about, is the more assets that you can protect for yourself.
Mm-hmm.
If stuff were to hit the fan, that's absolutely a conversation we're having with people, and one that should definitely be thought about.
How many years in advance of their exit do business owners typically bring it up with you? Hey, I'm thinking of selling, getting out of this. I'm exhausted, or there's something else to do, or just for any reason that they're ready to exit the business.
Yeah, I most commonly, and this is where I think, and we'll talk about this here in a little bit, but where a little bit of the disconnect is, but I will most commonly get a business owner that says, I want to sell in the next 12 months to max like 3 years. And I think
Hmm.
that's kind of the perception of like, oh, I only need like a year, a couple of years to get everything in order.
Right.
But on my end, the way I would say is like if I've met a business owner and let's say they're already operational, they're doing well, they don't have a sell date in mind. This is somebody in maybe their mid 30s, mid 40s. Then I'm going to say at least 10 years is going to be the amount of time we need to start planning for. Because in order to build passive income retirement accounts, if you're going to use cash balance plans, you need a decade plus for the compounding interest to even make sense for you to build something.
Hmm.
And on the flip side of that, as I said earlier, a lot of my business owners I'm working with are pretty new. And so it's a discussion from day one. You touch on it in your book where, yeah, sometimes you can't always do it from the get go. But if you're not thinking about from day one of your business, how you're going to have one, a passive income stream for yourself, but then two, how to take yourself out of the business. So many
Hmm.
of my clients I work with, and we're helping them with this, but they start out as their business is them, or their business cannot operate without them, which means the value of their business when it comes time to sell is very minimal because without said
Hmm.
person,
Right.
then what is someone buying? Most people that are buying a business right now want
Hmm.
to have something that's a little bit more turnkey that they can add some more automation to. They can add a little bit more higher prices, maybe add a subscription model, and then they can package that up and it's another passive income source. No one
Hmm.
wants to buy a business that one guy and an assistant has done plumbing work for 40 years and all they have is a list of clients. Like there's some value in that, but that's not going to relate to getting you a quality sale for your business. And so planning that from day one of not only one putting money away into these 401ks, mega backdoor Roths, cash balance plans, that's important, but also trying to make yourself an owner of your business and not an operational manager of your business.
Right. You want to be an owner and not an operator. If you couldn't go on a vacation and sail around the world and have business going without you, you're not in a position to sell. You know.
Exactly. And I think a lot of people don't associate the fact that their business could do $5 million a year in revenue, but if it needs
Hmm.
them, their business is worthless in the idea of being sold. And I mean that with quotation marks, but in
Hmm.
comparison to like, let's say a car wash, a fleet of car washes that run on automation, have a couple employees, and the owners haven't been there more than once or twice a year to make sure
Hmm.
everything looks fine. That's a business that's going to sell really well. And so, yeah, getting people to make their businesses closer to that instead of, like I said, a guy in a work truck for 40 years and then wondering why no one wants to buy his business after
Hmm.
40.
Well, there's a lot of size, businesses of the size where they're naturally going to tend to be an owner-operated business, and you will, if you want to be able to sell that as well, but you want to be able to have it structured well enough that you could make a transition to a new owner. And I think you nailed it with you can't have all the customers dependent upon you. You can't have all the employees going to scatter the moment you leave. It has to be able to transition to a new owner.
Yeah, no, absolutely. I think there's ton of planning that needs to be done. I'm going to tell a business owner if I've met him off the bat 10 years, if I'm starting them from the get go, we're going to talk about those ideals from day one.
Mm-hmm.
Um, but it's to answer your original question. I feel like most business owners only feel like they need like 12 months to a couple years, and I just don't feel like that's accurate.
No, no, that's barely enough time to even put it on the market and get it sold, honestly.
Exactly.
And I always say to people who own a business, I'm like, congratulations. That how do you know how you would be able to sell your business? And if people don't have a plan for it, I'm like, if you can't visualize how you would be able to sell your business, you don't own a business, you own a job.
Yep.
And so that's the difference here. How would exit? People will assume that some of their key employees want to take the business over, and if you sat down and asked these key employees, they'd be scared to death to do it, and it's often not the most lucrative way to exit. So there's a lot of planning, and it's good that you push people in this direction and push them early. um, outside of the business and building the value and having the business in a condition to sell, and what are you doing with their other finances? What are you looking for to make sure that this whole thing dovetails together and the people retire with the assets they need to retire comfortably?
Yeah. So for me, it's a year-to-year balance of what's a lot of times needed for the business tax-wise. So my most common recommendation plan that we're going to do for a business is a 401k or a solo 401k
Mm-hmm.
for business owners. And because of that, the reason because of this is because you can do post-tax deferrals and you can do pre-tax deferrals. And so the nice thing about that too is you can do different amounts in different years. And so my most common investment vehicle and tax strategy we're going to use for a business owner and their
Mm-hmm.
employees is we're going to offer a 401k plan to them. And what this is going to do is it's going to allow the business owner in years that they need more write-offs, they can write up to $67,000 a year,
Mm-hmm.
62,000 if they're under 50. I think the numbers are going up for 2023. I have to learn them for next year.
Mm-hmm.
But essentially they can write off X amount, and then we can attach what's called a cash balance plan on top of that. The constraints on those get a little bit trickier, but I'm working with a client right now where she's able to write off another $150,000 a year into a cash balance plan on top of the full pre-tax contribution she's doing into her 401k. So she has almost $200,000 a year that she's not paying taxes on. And it's
Mm-hmm.
completely being deferred because that's what she needs right now. Because the way her business is set up right now and how short she has to retirement, her tax bracket is going to be almost a third of what it is right now. And
Mm-hmm.
so we play a lot more benefit into that business owner going into pre-tax type of accounts to minimize that tax bill today because she's in a 30-something% bracket, and we'll have her pay taxes down the road when she's in a 15 to 20% tax bracket. The flip side of that is the other business owner, and kind of in my opinion, the more ideal situation is their business is able to come up with a lot of the write-offs and deductions they need. And so they don't actually need to use their investments to make pre-tax deferrals. They're actually okay making post-tax. And one of my favorite things to do is called a mega backdoor Roth. And
Mm-hmm.
what that does is let's say you're the business owner right here, you're
Mm-hmm.
going to contribute, and I'm going to say you're over 50 years old too. You're going to contribute $27,000 into your post-tax Roth 401k as the employee. And
Mm-hmm.
then you're going to make a non-deductible contribution into your 401k as the business owner. And come tax time, you're going to convert that into a Roth IRA.
Mm-hmm.
And what that's going to do is every single cent of growth moving forward, assuming you wait till 59 and a half in 5 years, is going to be tax free. And so if
Mm-hmm.
that business owner doesn't need the write-off up front, then we can literally be doing about $60,000 to $70,000 a year into post-tax Roth accounts. And
Mm-hmm.
with a little extra work and paperwork, I mean, there's stuff that comes with that. But I have business owners that come to me or W-2 employees that make too much, and they don't even think they can have a post-tax Roth account. They think they're over the income limit. And so
Mm-hmm.
that mega backdoor Roth is an awesome way for a business owner, if they don't
Mm-hmm.
need the write-offs on the investment side, to
Mm-hmm.
be having a tax-free income on the retirement side.
What percentage of business owners would you say have retirement plans with both, the conventional deductible contributions and the Roth aspects of their retirement accounts?
I think more commonly we've seen the pre-tax deferral, but I
Mm-hmm.
think that's a little bit more because of this. There's been a lack of knowledge, and honestly, on the advisor side, it's slightly easier convinced to say, hey, I can save you taxes this year. We can reduce your tax bill by X amount. And so unless you really explain the advantages of that post-tax,
Yeah.
most people immediately associate more positivity to that pre-tax deferral, which is why we see that more. For my clients, I'd say it's a pretty equal split.
Mm-hmm.
If we only need the deferral, I'm probably honestly going to go with closer to a simple IRA, maybe a 401k if the income's not quite there and we need to be able to have 100% contributed. But at the same time, like most of my clients that have a 401k, we have it set up to do post-tax deferrals. They can
Mm-hmm.
pick whether or not they want to do post-tax or pre-tax. And it really just depends on the year and what's needed for this tax year. Do we need write-offs this year? Or can we put money and save for taxes and not have to pay taxes down the road?
Mm-hmm. Speaking those two terrible words right there. This year, 2022. Um,
God,
yeah,
that taxes was one of them.
yeah, well, taxes is the least. There's a lot of people out there, present speaker included, that is, I've looked at my 401k and said, well, retirement is a few extra years down the road. People looking to exit. The market is cooling a bit. It's still, it's possible to sell right now. It's not nearly as hot as the market was in 2021. But are you seeing more people who saying, well, I need to hang in this game. I got to play a few more hands of poker before I'm going to be able to cash my chips in, because I just lost a few chips without even playing them.
Yeah, I think one, I'm hearing that. Two, there's a little bit that can be done in the advisor side that if you're having an advisor that's paying attention and you want your
Mm-hmm.
stuff actively managed to mitigate a little of that. But if it's as far as you're kind of just buy and hold 401k, here's what I kind of been telling people. When you look at a stock market, let's just say like the S&P 500's index and it's like average returns, it
Mm-hmm.
follows a fairly steady process where it goes up and then it goes down, and there's not too many extended periods where it just goes like this. There
Mm-hmm.
might be blips or months or couple months that it does that, but not for extended periods. What we saw in 2020 was an extension of people being at home with too much time on their heads, an influx of government cash that people weren't used to having, and really just a more accessible way to invest than we ever had through apps like Robinhood, TD Ameritrade, where the average 18-year-old with an extra $50 could go not day trade, but essentially play around with stocks and
Mm-hmm.
mess around. And so what that did was create, and then also combined with the fact that our government spent $16 trillion in 11 years, it created in my opinion, like a fake stock market. So for
Mm-hmm.
2 years, this entire market was built off returns that quite frankly shouldn't have been there. A lot of the businesses that did super well did really well because they did well during COVID, i.e., like Peloton, Zoom, Netflix. These are obviously businesses looking back that, yeah, if people are at home, they're just automatically going to do better. And so they had disproportionate returns. And so a lot of those things have pulled back now to
Mm-hmm.
where we're basically sitting at 2019, early 2020 prices for
Mm-hmm.
whether it's general stock prices or funds. And what I try to tell people is like, you got the gain you shouldn't have, and now you're taking a loss you shouldn't have, but you're going to start right back to where you kind of were in 2020 because
Mm-hmm.
none of those returns really should have happened. And if our government had probably done a little bit of a better job and we weren't in this exact environment, we might have just had a regular couple of years instead of the environment we're in
Right.
right now. But the only reason your account got so high in the first place was because it wasn't supposed to do 20-30% over 2 years in the first
Mm-hmm.
place. It should be doing 10 to 15% is more of a long-term average instead of 20 to 30,
Yeah. Yeah. It feels like it's been a huge shock to the system because we've been so spoiled with incredible returns and free money. Oh, okay, I have to refinance my house at 2%. Oh
2%.
boy, that's so expensive.
I have
I
some
mean,
clients in the ones.
what's that?
I have some clients in the high ones, like they pay
Yeah.
1.9, 1.8, and it's like that's just mind-boggling.
So I mean, this is honestly just a dose of reality here that it is a shock that they have to do so much at the Fed, and we're seeing the markets uh, take a beating, and everything's falling, bonds, stocks, you name it. But it's more of a correction than I think a long term sort of. I don't expect that over the long term the U.S. stock markets are going to be a bad place to have your money.
No, I don't see that either. And yeah, we'll get into a little bit more of the data in a couple minutes, but there's some data I think that's starting to back up too that if we really look at this from a 10,000-foot view, things aren't
Mm-hmm.
quite as bad as a lot of things are being made out to be.
Go ahead into it. Show
Okay.
your stuff.
Okay, I'll strip my stuff. So here's a couple just stats right off the bat. Since we've had midterms since World War II, we have never had a negative year in the stock market after midterms, and here's why. First year of presidency, they're trying to appeal to voters. Same with the second year. Third year of presidency is where you get the people's vote. The people's vote comes from the middle, whether that's right or left. It's the middle is where you're going to win your presidency, right? And so the middle is most influenced by how the economy is. What are gas prices? How's your 401k doing? Things that people can directly look at and make positive or negative associations with. So throughout history and basically the last 100 years, every time we've had a midterm election, the market's gone positive the year after, and it averages 15%. Another thing to be thinking about too is that we have never, ever, since I believe it was World War I, not had a positive market year following right after or I'm sorry, I combined my 2 points right there. That was
fine.
Yeah, but third year of presidency and then right after midterms. So those are the two big things right there. Another thing is we look at fund prices, we're right back to like 2019 levels. If we look at the inflation, it's fallen on a running average now of 3 months. Technically, it's 0.1 higher than it was a year ago, but it's a rolling 12-month average. It's gone down the last 3 months. If we look at what the Fed's been saying, they just decreased their rate hike to 0.5. They were doing 0.75. I do think we'll continue raising rates into next year. I don't really see a scenario that past Q2 of next year, we're going to be raising rates because right now we're at the highest level since 07. Like we're already starting to peak into that realm. One of the other big things that the Fed looks at and that I kind of am a little bit in personal disagreement with is the labor market right now. And they're still using that as an indicator. So basically one of the biggest things the Fed has said is we're not going to stop raising rates until we see the labor market get crappy. Essentially, until people are feeling the constraints of not being able to find a job, we're not really worried about continuing to raise rates. And that historically has been once that unemployment rate hits a number they're comfortable with, that's when rates stop going up. I think we're in a little bit of a different environment for a couple reasons right now. In COVID, we shut down so many jobs that the the unemployment rate right now is very skewed. The second piece of that too is we also have a gig harbor economy right now that we've never had before. That being like Uber, 1099 contractors, social media, drop shipping. I mean, Amazon Prime workers. There's the list goes on and on now where people aren't technically W-2 employees. They're 1099 contractors and they do. And I think part of this is because we have such a short-term attention span right now in society. You know, people are doing 1, 2, 3 different things, but they're not employed at a job, which is skewing the numbers. And so I think once you take that labor market number out, a lot of the other things are indicating that, are we at a bottom yet? No, we're not going to bottom out till the Fed's done raising interest rates. But as an overall economy, are we doing okay? I think so. Like we've seen gas trend down now for the last 3 months, pretty much consecutively. Like we are not in the economy we were a year and a half ago, but we are definitely not where we were this summer too. And I think that's an important distinction to remember.
And would this market insight apply any differently for people who are business owners and they do have a lot of their net worth wrapped up in their business? And the certainty of selling a business and getting the full value of what the enterprise is worth, that's more questionable than the certainty of being able to draw down your retirement account. Do you see different advice for the business owners? Do they need to be in safer investments?
Yeah, I think if there's less, it's part that, and then it's also most like the biggest part's going to be timeline. If a business owner is 20 plus years out, realistically, that aggression level is not going to be much different just because they're a business owner.
Right.
That part comes down to the timeline.
Sure.
But let's say they're 5 years out and I got to get somebody to retirement and they need X amount of passive income. Whereas the business owner needs a little bit more of a safety bucket over here, and the business is going to predominantly fund that passive income in retirement, then yes, we're going to be much more conservative in a time like now, try and protect profits, even if that means moving to money markets earlier last year, moving into, I did this with a lot of people, but moving into maybe a little bit more energy sectors, things that we know are going to do well during a recessionary environment, or at least not lose money during a recessionary environment. So yeah, biggest thing's timeline, but I would say at a certain, if you're under 10 years, we're going to treat the business owner's money a little bit different than the person that I need to get to X sum of money to actually create an income for them.
Now, when you're working with a business owner and they are getting closer to that exit date, and they're going to have a big capital gain event, and some of it may be even recaptured as ordinary income. Do you work with them and with their tax advisor on ways to do tax planning? Is it kind of an integrated effort where you work together to
It
realize that there's going to be
absolutely
a
is.
big, go ahead.
Um, I think the CPA drives that bus and the estate planners drive that bus a little bit more than I drive that bus. But
Mm-hmm.
there's absolutely a team coordination that's going on to make sure that we can minimize that tax bill in the biggest way possible. Whether that be, you're setting up that business to be sold that you're taking a passive income for a while, or that you're getting the amounts in chunks so you don't get a singular big capital gain event. But while I'm involved in the process, I do feel like that's something that the CPA is going to drive the bus on a little bit more. To be totally honest with you.
And that's absolutely right. That's the perfect advice. Everybody needs to know what's going on. The right hand needs to know what the left is doing so they don't screw anything up. And they do know, you need to know, okay, this is the advice you've received from this other advisor, and everybody needs to stay in their lane.
Yep.
People ask me tax wise, I was a CPA before I went to law school, and I'm literate in issues. But I say your tax advisor, your CPA knows where the rubber meets the road. They've been preparing your tax return. They're going to be the ones to prepare your tax returns the year you sell your business and thereafter. That's the one you need to talk to.
Yeah. And I think, just to throw this out there for the business owners listening, if your CPA and your especially financial advisor are not connecting on a yearly basis, and ideally for joint conference calls with you on, you're seriously missing a level of service, because I can't do my job without a good CPA, and a good CPA can't do their job without a good financial advisor. And so if
Mm-hmm.
you're not getting that kind of 1+1=2 service, then you're generally, whether it's going to be on the back end or year to year, you're missing out somewhere. And so that's something to be thinking about for the people's listenings and their relationships with their
Mm-hmm.
advisors.
How is the local business climate there in the Meridian Treasure Valley area? There's been so much growth, and I just, how are things going there economically?
Okay, so 2 points to that. I think on one hand, we're becoming a little bit of a booming tech economy. We've had Micron here for a while. We've had Amazon move a facility out here. We're now having Meta build an 800-acre facility out here.
Mm-hmm.
And so, because of the relative cheap cost of living, but still fairly central to other major metropolitan areas,
Mm-hmm.
you're actually seeing a lot of smaller tech companies start up underneath the big umbrella that Meta and Amazon and Micron have kind of created here. As
Mm-hmm.
far as on the town economy, I actually think there's a little bit of problem we're seeing right now, where we have a ton of influx of money coming in out of town, going into Boise, Eagle, and Meridian, and they're wanting to start building up or continuing to expand residential, but they're not. I was actually just talking to one of my clients that owns an automotive shop. Like, they're not really giving permits to build more body shops in Boise right now.
Mm-hmm.
And all of the auto shops right now are already pretty tapped out because of the influx of people that are coming. And I've heard this in the restaurant business. A lot of like the coffee shops are struggling to staff because they have these coffee shops in the middle of suburban Meridian, but they don't have anyone within 20 minutes that can afford to go work at those shops unless they're like a high schooler living at home. And so I don't think it's going to ruin us, but it's before Idaho was able to run on, you just hire the high schoolers and you hire the youngins, and then, there'll be enough service people to take care of the suburbia and the city here. But with all of the influx and all of the people working from home and working out of other states, it started to limit the amount of service that's being created in the restaurant world, in car industries and retail. And I know it's in other cities, but there's tons of, looking for help. There's businesses closing Monday, Tuesday because they can't staff
Mm-hmm.
to stay open. And so that's something I'm noticing on the local economy, that even with all the almost a lot of the growth is harming the local business growth because they're pushing so much to get more residential people in.
Okay. So it sounds like there might be some issues with the Main Street economy. The tech startup economy is thriving. You're seeing much in the way of early stage funding. Do you have very many angel investors or VCs that are funding startups in Boise
Yeah, so
and Meridian?
I have a couple clients that do that personally. To be totally honest, I am not like super connected into like what deals they do and all of that
Mm-hmm.
fun stuff. But there's a more than a couple programs right now. Like there's Boise Entrepreneur Week. Um, there's a few different programs right now that if you have a business idea, you
Mm-hmm.
can easily go sit in front of a panel of angel investors. In fact, there was just an event last month in Boise
Mm-hmm.
that you can present your idea, your product, whatever your whatever your idea is, and if people want to invest in it, they could. And so I think there's a massive boom here for that in Boise. And then you look at like facilities like Kiln that was just built, Meridian, that co-working space. There's a lot of kind of more tech and automation software-based businesses that work out of that development space. It's also like a really new way for those listeners that don't know what Kiln is. They basically got a big building together, put a
Mm-hmm.
bunch of offices, conference rooms, seating area, snack stations, and you can rent out a room for a month or a day, rent out a conference room for an hour. And it's
Mm-hmm.
become this co-working space that I think society will continue to trend towards with this gig harbor economy. I feel like as you asked earlier, as a business owner, how can you be paying attention finance wise, but just as a business owner, paying attention to trends of like, the gig harbor economy, co-working spaces. Maybe you don't need to rent and lease out a space all month. Maybe you realize you only actually need a space for team meetings a few times a week and you just need somewhere you can work out of. And
Yeah.
so I think Boise is really creating opportunities for business owners that are starting something to have the opportunity to not have to go buy a building and have employees. Like there's a ton of automation and a ton of ways that you can build a business that in non-traditional ways here.
Well, Andrew, we're running out of time here, but I have to commend you here. You definitely understand issues that business owners confront, and your knowledge of the markets is extremely sophisticated. So you found your calling and you found a niche for yourself that seems to suit you perfectly, and it seems like you definitely enjoy it. I want to have you back on the podcast again and let you share more with the business owners.
No, I really appreciate you having me. Happy to give any information. As I tell everyone, I'm an open book. So I just like
Great.
to give knowledge.
Well, we'll see you listeners again next time on Selling Your Business with David King.